Okay, well, welcome to this webinar. I'm Liza Hanks. I'm an estate planning attorney. I practice in California, but most of what we're going to be talking about today is federal, so it would apply to any state. I know one person is here from Denver, but the rest of you have not shared where you're calling in from, but that's okay. So this is a webinar about understanding the estate and gift tax. And what I'd like to do is share my screen and kind of walk you through some PowerPoint slides to just get the basic concepts out there. And then I'm really happy to answer questions. That's actually usually the funnest part of these webinars. So if you have a question, put it in the Q&A so that I can see it. And we have Toronto, Ontario. Well, I don't know much about the Canadian system, but you can just listen along. And Oxford, Mississippi. That's so cool. Okay, so first, let me just pull up my screen and we'll start with the slides. And it's fine to ask questions while I'm talking with the slides, but we'll see how that works. I might want to hold the questions till later. You know, it just depends on how many questions come up. So I'd like to get started. So the first thing to know about the estate and gift tax is that it's only one of a series of taxes that actually can matter when somebody dies or wants to make taxable gifts. So it's really 3 taxes, and in some places 4, that you have to think about when you want to get the big picture. So there's the estate tax, and really that's the estate, as you'll find out in a minute. There's capital gains taxes, which are the taxes that fall on the difference between you buy something for and what you sell it for. The buy low, sell high paradigm involves gain, and those gains are taxed. And that can affect the estate and gift tax calculations. And then there's income tax issues that can, and capital gains is an income tax concept that can affect decisions that you might make around gifting. And I took this out of the slide because maybe it's more California specific, but property taxes also can be a factor when you're making an estate plan. If you live in a state where transfer of property generates taxes, it can be a consideration as well. So taxes are complicated, right? The different taxes depend on who gets the asset, what kind of thing it is, where it came from, and when you get it. So keep those in mind as we walk through the rest of these slides. The gift and estate tax is like a puzzle piece. They fit together. So that's why I picked this picture. The IRS figured it out that if they only tax people on what they owned when they died, a lot of people would give everything away right before they died and then die with nothing, right? And then they wouldn't have a taxable estate. So the IRS figured out that that probably wasn't going to work. And so they unified the taxes that fall on gifts, either during your lifetime or after you die. So that's why it's called the gift and estate tax. So you'll see in a minute that every single person is given an exemption against this tax. And you can think of it like a Pete's card or a Starbucks card for coffee, right? So if you have $30 on your coffee card and you go to the store and you get a cup of coffee, say you get a latte or something, now you've used up $5 off your card, right? So the exemption is kind of like that. It's a credit against the tax and you use it up as you go. And it doesn't matter whether you give the money away when you're alive or when you die for the calculation of how much of that you've used up. So I'm going to talk about that more. So let's start with the estate tax. Now this matters who pays the tax, right? It's an estate tax. It's not an inheritance tax. So that means if I die, the question is, does my estate owe a tax or not? It's not going to fall on the people I give the money to, right? So if I give the money to my kids when I die, they're going to get the money tax-free. The question is whether I am subject to the estate tax or not. In some other countries, I don't think Canada is one of them, but countries in Europe often have inheritance taxes. So that's the opposite, right? The tax falls on the people who get the money, not the people who give the money. But here in the United States, we have an estate tax. It falls on the estate. The maximum rate is currently 40%, so it's a pretty stiff tax. The good news there is most of us don't have to pay it right now because The exemption, right, that Pete's card is really, really, really big. It's $11.7 million per person. That's enormous. And the estate tax is only due if your estate exceeds that amount, right? So the vast majority of people in this country, and I'm pretty sure everybody on this call, we don't currently have taxable estates, but that's relatively recent phenomenon. So if you look at this, this table, in 2001, which is basically when I started being an estate planner, the maximum tax rate, right, was 55%. It's come down to 40% over the years. And the amount that you could give away tax-free has gone up hugely in that time. So in 2001, this tax fell on everybody with an estate over $675,000. In 2009, that was $1 million per person, and now it's 11.7 million. And that number comes from $10 million indexed to inflation over the last couple of years. And that was part of the Trump tax cuts. In 2017, that number was $5 million per person indexed to inflation. And then the Trump tax bill doubled that to 10. So why am I telling you this? Well, I'm telling you this because historically, we're in a very unusual time. Generally speaking, like for sure in 2001, when I started this, going all the way back to 1983, most middle-class people did have to think about the estate tax. You know, if you have a life insurance policy and some equity in your home and you have some retirement savings, it wasn't that hard to get up to $1 million of taxable assets, right? So the current climate in which, we don't have to worry about it, it may not last, right? It's possible that the Congress will pass new laws and lower that limit. And the current law expires in 2025. So that means, what that means is if that Congress doesn't act or can't get their act together, it just goes back to what it was in 2017, which is $5 million per person, indexed to inflation. So it'll probably be like 6 point something. And so that brings the estate tax down closer to an area where some of us might have to worry. Like where I practice, I'm not so far from Palo Alto, Silicon Valley. I have plenty of clients that they don't feel wealthy, right? But their homes are worth $3 or $4 million. Or they have IRAs or 401ks with a lot of money in them because they were professors at Stanford or something. So it's possible that in the very near future, even the middle-class people, or who think of themselves that way, if you're from another part of the country, you're probably thinking, oh my God, how do those people think they're middle class? But they do. We'll have to think about it again. So this is an odd historical moment to be talking about this, I think. Right now, though, less than 1% of the estates in this country are subject to tax. So those two little red dots in the bottom, that's like my graphic representation of the number of estates that are actually taxable last year. So it's still kind of nosebleed territory. But even so, people who aren't subject to the estate tax have lots of questions about the gift tax. I talk to people all the time in my practice who have this idea that they can't give away more than $10,000 without paying gift tax, and it's not true. So I want to disabuse you of that notion. So let me walk you through how the gift tax works. Okay, like I said, this exemption that you get, your get out of jail free card, your Pete's coffee card, applies to gifts that you make when you're alive or when you're dead, so that you can't give away all your money and not pay tax. But there's another carve out to that, which is you have an $11.7 million exemption for sure, but you also get to make gifts every single year up to a certain amount without using any of the money on your get out of free card. And that's called an annual gift tax exclusion. And that used to be $10,000 a long time ago, but it's also indexed to inflation. So it's gone up little by little, and now it's $15,000 per person per year. So here's how that works. I could decide to give $14,999 or $15,000 to every single person in Detroit if I wanted to. I could give $10 million, I don't have that much, but let's pretend, $10 million away that way. But no single gift exceeds $15,000. And so none of those gifts have to be reported to the IRS, and all of those gifts are free of the gift tax. tax. So here's an example. And all of those gifts are cumulative. So okay, wait, let me go back. First thing is there's annual exclusion gifts that don't have to be reported, and any gift over $15,000 does have to be reported. So let's talk about that first. The way to think about the federal gift and estate tax exemption, so I've been calling that the Pete's card, the get out of jail free card. Here's another way to think about it. You could think about it like a sports clock, like a basketball clock with a lot of time on it. Right now we have a really, really big clock. It's $11.7 million of time. But when I started this practice, my son was born in 2001. It was $1 million clock, much, much smaller. No matter how big the clock is, though, the idea is that every time you make a gift that you do have to report, you're using up a little bit of time. That's the little red wedge on the clock. And no estate tax or gift tax is due until you've used up all of the time on your clock. Okay, so here's an example of a person who in 2014 gave $100,000 to like a son to buy a condo. And in 2016, they gave $200,000 to their daughter to help pay for the twins' college tuition costs. So each year they had to report that gift on what's called a gift tax return. They didn't have to pay any taxes, right? But now they used up $300,000 on their clock, right? They told the IRS that they made big gifts in those 2 years and they filed those returns. That's how the IRS keeps track of us. So this person used up $300,000, but she still has $11.4 million left. So there really is no downside to using up some of that exemption for her, okay? In the old days, in 2001, when that was only $1 million worth of exemption, these kind of gifts had a big effect because she was using up 30% of her forever ability to avoid the estate tax. But in the current environment, it doesn't really affect us that much because we have more exemption than we have money, right? So we never have to worry about using it up. And as I said, annual gifts don't count. So that $15,000 I gave to every single person in Detroit, I didn't have to report any of those gifts. And I could do it again next year, and I could do it again the year after that. So it's like a checkbook that I can use every single year. And if that estate tax exemption comes down in the future to 5 million or 3 million or even 1 million, this kind of planning would become more important. So back in the early 2000s, if you were a wealthy person and you wanted to be smart about using this exemption, you might make a gift every single year to your children, to your grandchildren, to their spouses. And if you did that for 10 years, you could get 300,000, say, out of your estate without paying any tax at all. So this kind of planning takes time, and it's a worthwhile kind of thing to do if you want to protect your exemption. Okay, so here's some examples about how that can work. Here's Donna. She's giving her 3 grandkids and their 2 parents $15,000 each. Okay, so that's 5 people. So that's $75,000. But none of the gifts, none of those exceeded $15,000, so she doesn't have to report any of it, and she still has $11.7 million of exemption left to use. If she had given one person $20,000, she would have to report all of the gifts, right? But she kept all of them under 15 because she had a good advisor, and she didn't use up any of her exemption. But in 2020, Donna decided to give her son $85,000 as a down payment on a condo in Denver, because somebody on this call is from Denver. And that gift is more than $15,000, right? So now she has to report that on a gift tax return. She doesn't owe any money, right? But now she has some time on her clock. So the first $15,000 is an annual gift, so she doesn't have to report that. But the $70,000 she does. So now she's used up $70,000 of her lifetime exemption, and she has $11.69 million left. And if any of you work with accountants and you get that annual planner when they're getting ready to do your taxes, you'll see that one of the questions they ask is, did you make any big gifts this year? And the reason they're asking you that is to find out whether or not they have to prepare a gift tax return in addition to your income tax return. But here's the big point of this whole tale. If $11.7 million is more than you have, certainly more than I have, if you want to give people more than $15,000, it's okay. You know, you're not going to pay any gift tax, and you're not really, it's not a problem to use up the exemption because you have plenty. You have more exemption than money, so you don't have to worry about using it up first. And there can be good reasons to give up money away if you can afford it, to help your kids or to help other people in your family. So I just want people not to feel so concerned or constrained by tax purposes when they're making gifts. Obviously, don't give away something that you need, right? But what I'm saying is don't not give it away if you want to, because the gift tax situation is very favorable right now to you. So if we don't have to worry about taxes so much in this current environment, what should we be worrying about? So a couple things. Being smart about capital gains. And if you live in a state where property taxes are an issue, California is one of them. So I've been trained to be very conscious of property tax issues. You should worry about that. You should be worrying about or being smart about giving to charity if that's something that's important to you. And I'll give you some ideas in a minute about ways you can do that. And you also want to make sure that you have an estate plan, obviously, and that your beneficiary designations are up to date. So I want to talk about these three things for a second, too. Okay, capital gains. That's the tax on the difference between what you bought something for and what you sell it for. And if you make money, right, buy low, sell high, then you have some taxes to pay on that gain. And that's what are called capital gains. And if you're a tax geek, I'm talking about long-term capital gains, not short-term capital gains, because most estate planning gifts have to do with things that you've had for longer than 3 years. So this is something people often don't know, at least my clients don't. If you give something away during life, it has very different tax consequences than if you give it away at death. And I'm going to give you 2 examples to sort of explain that to you. So the issue is basis. So basis is, in my story about buy low, sell high, basis is what you bought it for, a low basis and a high sale price, okay? If you give something away while you're alive, the gift comes along with your basis in that property, right? So here's an example. Douglas gives his daughter Kate 100 shares of stock. He bought that stock for $1 a share, or maybe he was given that stock for $1 a share. And now it's worth $101 a share. So he bought low and sold high. There's $100 of gain on every stock, every share that he owns on that stock. So he gives Kate this stock. And if she decides to sell it because she wants to use the money to pay for college for her kids, she's going to pay the same amount of capital gains that he was going to pay, $100 a share. And capital gains on that is about a third of that. So 33% of every dollar she earns is going to go to capital gains taxes. Okay? If instead she inherits that from her father when he dies, so he didn't give it to her now, but his will or trust left everything to her, she's going to inherit it at what's called the stepped up basis. It's going to be revalued to what it was worth when Douglas died. So here's how that works. So if Kate inherits that stock from Douglas and it was still worth $101 a share, she would inherit it as if she bought it for $101 per share. That's called a step up in basis. So Doug's basis in that stock was $1, but it got stepped up, it got raised up, it got revalued to what that stock was worth when he died. And how do you know what that is? Well, you have to run a report. You have to ask Charles Schwab or Fidelity, whoever's holding those stocks, to, it's called an estate valuation report. They'll tell you exactly what those shares were worth on the day that person passed away. And it's an average of the high and low stock on that one day. So it's a snapshot. So if Kate inherits that stock at $101 a share and turns around the next day and sells it for $101 a share, she's going to owe 0 capital gains. So, I mean, that's a big difference, right? 33% of every share, right? Versus 0. And so, well, why am I telling you this? Well, if you're somebody who wants to think about making gifts to your kids of appreciated assets, it's a good thing to know, right? It's better if you can afford it to pass things along when you pass away, generally speaking, for tax purposes. And of course, that's not always an option that people have, right? Sometimes they have to sell their house to move into assisted living and they just have to pay the tax. But if you have a choice, right, a step up in basis is a better thing than paying capital gains if you don't want to pay tax. And with respect to charitable giving, these are some simple things that you can do. Name a charity as a beneficiary on your IRA or a 401k, or what, like 10% of my IRA is going to go to Doctors Without Borders or the Humane Society or Guide Dogs for the Blind. And why is this a good idea? Well, look, if I'm Guide Dogs for the Blind and you leave me $100,000 from your IRA, I get all $100,000, right? I'm a charity. I don't have to pay income tax on that withdrawal. But if I leave $100,000 of my IRA to my daughter, Kate, she's a person. So she has to pay taxes on that $100,000, just like I would have had to pay if I'd taken the $100,000 out while I was alive. So if you have charitable inclinations, it's a really great thing to give money to charity through your retirement plans, because it's like you're increasing your gift by 27, 30%. Another thing that you can do while you're alive, so like my guy Doug, right? He had those stocks that went from $1 to $100 a share. I know it's a rich person problem, right? Like this problem of like, I don't want to sell the stock because I don't want to pay the tax. Truthfully, when people tell me that in my brain, I think you're paying the tax because you made a bunch of money, stop complaining. But still, if Doug had charitable inclination, he could also 100 shares of that stock to Guide Dogs for the Blind. They could have sold those stocks. They wouldn't pay any capital gains either because they're a charity. So again, he could make a very tax efficient gift to the charity. He would, if he gave it while he was alive, he would get a tax deduction for the fair market value of that stock. Give it all to the charity and they would have it all to use for charitable purposes. So that's a smart thing that people often don't know that they can do. And my final piece of advice before I stop for questions is, okay, this is a picture of train tracks. Why did I pick a picture of train tracks? Well, people often don't know that their IRAs, 401ks, life insurance, anything else with the beneficiary designation, it's like a separate train track of money going to your beneficiaries. It's not part of your will. It's not part of your trust. You have a legally binding contract with, Fidelity that says, hey, when I die, give my IRA to my cousin Nick. Okay, so when I die, Fidelity is going to give my money to my cousin, nephew Nick, because I don't want to get sued for giving it to the wrong person. And if my evil nephew Charles calls them and says, actually, I should get the money, Fidelity is going to say, you're not the beneficiary. We're not going to tell you who the beneficiary is, and we're not going to talk to you, right? So there's a built-in legal protection because Fidelity wants to do what you ask them to do so they don't get sued. And what I find in working with people is they often forget to check those. And sometimes they die and find out like, oh yeah, that 401k or that IRA for my very first job when I just got out of college, I named my brother because I wasn't married and I didn't have kids. Well, guess what? Your brother's still going to get the money. So you don't want to do that. And if you are in the process of getting divorced or you've been divorced, you definitely want to update those. It gets a little complicated legally. In California, IRAs are governed by state law, but 401ks are governed by federal law. So the rules are different there. There's like automatic revocation of beneficiary designation. Feds don't recognize that. So I've even had clients where an ex-spouse gets the 401k, even though obviously that's not what they wanted. So just a little bit of background there on how this works. And now I'm very happy to answer questions. So I'm going to open up the Q&A and see if anybody has questions for me to ask. I could talk more, but I find that 30 minutes of law talk is usually enough for my audiences. So ask away, or we'll just sit here and enjoy the quiet, I guess. So really, or we can end early as well. So let's see if anybody has a question. Come on, I guarantee you that whatever you're thinking out there that is a dumb question is not a dumb question, and 5 other people have it. That's been my experience anyway. Nothing. Okay, I have a hand. I don't really know how the hand thing works. So if you could, do you think you could put your question in the Q&A?
I've been asked to speak, so I'm going to speak.
Oh, okay. That's new for me. Let's do it.
So I'm very curious if you know anything specifically about cross-border gifting and so forth. So
you're asking from Toronto, I see.
Yes, and I have children who reside in the United States and most likely will stay there. So of course I'm curious about that, and wonder if the same rules apply for them inheriting, if they're inheriting something from me in Canada, or does it get far more complicated?
It gets a little more complicated. And when I have clients from Canada, or usually my clients are living here, but they have property in Canada, I always encourage them to check with a Canadian attorney, because the gift from you is going to be taxed under Canadian law, right? And Canadian law is different than our law, right? And so I don't know what the gift consequences for the gift for you would be in Canada, but I can tell you that your kids, okay, in the United States, a gift is not income under the tax code. That's why we don't pay taxes on gifts, right? The gift comes to us tax-free, but the gift that you're making may be subject to Canadian tax, and I don't know the answer. I'm sorry.
That's okay. Thank you.
More than that. Yeah. Okay, so now we're getting some questions. Go audience. Okay, so they're in 2 places. There's a question in the chat, and then I'll go to the questions in the Q&A. Is it possible to set up a trust for a child with the value against the gift tax? So if I understand your question correctly, and if I don't, say more in the chat box. Yeah, you can set up a trust. They're called gift trusts. You can set up a trust for a kid, and you can put $15,000 in every year, okay? And this is often done, actually. And then the trust can have its own terms, so usually trusts like that will say, when a child is 30, they have access to half of the money, and when they're 40, they get all of it, for example. And so the value of a trust like that is it allows you to make use of that exclusion gift every year, but it keeps their hands off it, right? There's adult supervision until they're a certain age. So, okay, now I'm going to tell you it's actually true. This kind of trust is called a crummy trust, not because it's a crappy trust, but because a guy named Crummy came up with this plan, and the IRS eventually, after some back and forth, and IRS approved it. So the planning technique goes like this. I asked for my son, Sam. He can't use it till he's 30. I put money into that trust now, 2021. In order for that to count as what's called an annual gift, I have to do this thing called a crummy trust, which is to say, I put the money in I set up a trust. The trust has its own bank account. I put the $15,000 into the bank account, and then the trustee, who isn't me, usually sends a letter to Sam and says, hey, Sam, $15,000 just went into this trust. You have 30 days to withdraw it. If you don't withdraw it in 30 days, then it goes into the trust and you can't use it till you're 30. And that works. It counts as an annual gift in 2020 or 2021, as long as he was notified and he had a reasonable amount of time to withdraw the money. But of course he wouldn't, right? So it's a little artificial, but those are the tax rules. And if your kid is like 2 years old or 3 years old, the letter goes to you as the guardian of the kid. And you go through this formality of a right to withdraw that you then don't exercise. So that's how you do a trust for kids. And if that answered your question, great. If it didn't, tell me more. Here's one that came in the Q&A, and it says, can you talk about when you recommend using a will versus trust when most of the inheritance will be property at death? And what about taxes on inheriting and selling property? So I'm assuming by property, you mean real property, like land and houses, right? RG Experience team would like to answer this question live. I have no idea what that means, so I'm just going to answer it.
You're answering it live, Liza.
Oh, okay. There you go. Well, whether to use a will or a trust is actually the subject of other classes that I've given in EOL Collective, and I believe they've been recorded. It depends on where you live, is the short answer. If you live in a state where the probate process has been reformed and modernized so that it's not incredibly expensive and time consuming, then you can probably accomplish your estate planning goals with just a will. If you live in a state like I do, California, where the probate process is the opposite of inexpensive and fast, which it's expensive and slow, then avoiding that process is a benefit to everyone, including especially your beneficiaries, like your kids. And in states like that, you would rather use a living trust. So it depends on where you live. The taxes on inheriting and selling real property are not different than the taxes on inheriting and selling anything else that I've been talking about. There's a step up in basis, just like there was for the stock. There's the same rules about gifts during life. If I give my house to my kids during life, they're going to get that house as if they bought it for $100,000, even if it's worth $1 million, for example. If I give them the house at my death, they're going to inherit it $1 million as if they bought it for $1 million. So it's the same calculation. There's the only difference that I can think of between real property and, what's it called? Personal property, like financial stuff, just has to do with property taxes. And it depends on where you live. So again, in California, where I live and practice, until last year, because of something called Prop 13, kids were able to inherit a home and pay the property taxes that their parents were paying, which was much lower than they would have to pay if they purchased the house. And that just changed in California, and I'm not going to talk about it on this webinar. But to say that it's possible that real estate property taxes would be different in your state, and that's the only thing that's different between real property and other kinds of property. Okay, here's another question. I have inherited a 401k, but I don't know when the best time is to withdraw. That's a great question. So here's the deal. Again, new legislation has really changed the calculations on this one as well. So there was a new law called the Secure Act that passed about 2 years ago now that really changed the answer I'm going to give you. So if you'd asked me this question 3 years ago or 5 years ago or 10 years ago, I would say the best money from a 401k is as slowly as possible. And you are allowed to take out a little bit each year based on your age and only pay taxes on that little tiny bit. But the new legislation has changed that. And so now for most people, the rule is you have to take all of it out within 10 years of when you inherited it. So, but in that time frame, there's no requirement that you take it out. As long as it's all gone by the last day of the 10th year, you're within the rules. And so you have to decide for yourself, do you want to take it out, in smaller chunks or a little bit each year for 10 years, or how you want to structure that withdrawal, because the taxes, of course, have to get paid on the money as it comes out. So, and unfortunately, a lot of us inherit these things in the middle of our lives when our parents die, when we're sort of at a high income tax bracket. So this is a big tax hit for a lot of people, which is, of course, the reason they wrote the legislation. They were trying to liberate trillions and trillions and trillions of taxable dollars that are stuck in these retirement accounts. And the government was like, we set these up so that you could save taxes when you were working, right? You could push money into these things. And then we made you start taking them out when you're 70 and a half. Now, but we weren't really thinking of these things as, like estate planning vehicles. We didn't really think that your kids should get that same benefit. So now they've shortened the time. So I hope that answers that question. Another question. I love these questions. Thank you. If I set up a $1 million trust for my kid now, will this be taxed or included as part of the estate tax exemption? You bet. A gift to a trust is considered a taxable gift, just like a gift outright. So if you set up a trust for your child and you transferred $1 million to that trust, and that trust is an irrevocable trust, right? Like, has to be a completed gift, right? A completed gift is you can't get it back. strings attached that would allow you to pull it back into your taxable estate. You really have to give it away without any retained powers that somehow would creep it back into your estate. You would $1 million gift on a gift tax return. Why would you do this? Well, people who are wealthy do this because they want to reduce their own taxable estate and they want the appreciation on that $1 million to grow in their child's estate, right? So like if you worked at Google, so all my examples are Silicon Valley examples, and I apologize for that, but that's where I practice. You worked at Google when it was a startup and you had $1 million, you had 1 million shares of Google that you got for a penny a share. And there are people like that in this valley. A really, really smart thing would have been to give some amount of that at $1 a share, a penny a share, to trust for your children. Because let's say you put $50,000 of that stock in a trust for your kid at a penny a share. And then that stock goes public, and now it's worth $500 a share. I don't know what Google's worth now. All of that appreciation is now in your child's estate, not yours. Of course, if they ever sell it, they have to pay a lot of capital gains. So these are things that wealthy people do to move money around in a tax efficient way. And the other reason that people are doing this kind of thing right now, so I don't do this kind of wealth transfer planning. I just like helping normal people get their act together. But if you work with very wealthy people, at the moment, they are giving away money hand over fist because they think that the Biden administration will lower that exemption from like 11 to 5, let's say, or 3. And if you're wealthy, now's a terrific time to give it away because you can give it away for free. And if the exemption goes down in the future, they're not going to claw it back. Like you already made that gift. So that's the wealth transfer planning right now, is a lot of that kind of trust. Any more questions? No more questions? Well, more minutes. I'm happy to wait a little while if anybody does have questions. One thing I did want to tell you, and of course I didn't share my screen to show you, so I'm going to put this back up on my screen for a second. Hold on a sec. There's some other resources that are available to you. So if you can see my screen, I have written 2 books. One is called Every Californian's Guide to Estate Planning. But it's pretty national in scope. I mean, all of the concepts, except for the property tax chapter, are really national. So background and helpful information about wills and trusts and why you need them and how to do it. This other book here is called The Trustee's Legal Companion. So if you are administering a trust or you're going to have to administer a trust after someone dies, super helpful book for that. And then Women in Wills has become, it's a podcast. I have a lot of episodes out already under its previous name, but I've kind of rebooted it to be about specifically women. And I'll be offering online courses soon. So if you have any interest in that, you can go to womeninwills.com, probably starting in about 2 weeks. It's not open to the public yet. Or you can go to my website, lizahanks.com, and sign up for my newsletter, and you'll get information about upcoming courses and classes there as well. So on that happy note, I'm going to unshare my screen. How am I going to do that? I'm having a little Zoom problem here. I'm going to, I guess I'll just leave this up and wish you all the best. And I'm glad that you were able to come. So if there's any more questions, now would be the time to ask. And if not, I'm laughing at myself because I can't figure out how to unshare my screen. There we go. So I don't see any questions. So I guess I'll appreciate your kind words and keep an eye out. I'm doing these classes every month for the whole year. So if you like this one, 3rd Friday of every month, just check EOL Collective's calendar and I'd love to see you again. Take care.